Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day. Ever wondered why you don't get the medicines prescribed by some doctors anywhere else but close to their clinics? Or why medicines of some brands are prescribed more often than the others despite having the similar sound? Activists have been long alleging nexus between pharma companies and doctors who are wooed with freebies ranging from costly gadgets to foreign trips. One such allegation of bribery echoed in the Supreme Court last week, which termed it as serious. So, in today's segment, we ask why the Uniform Code of Pharmaceutical Marketing Practices is still voluntary and not legally binding.
The Federation of Medical and Sales Representatives Association of India, or FMRAI, has moved the Supreme Court with a petition. It wants the Apex Court to direct the centre to give the Uniform Code of Pharmaceutical Marketing Practices, or UCPMP, a statutory basis to curb alleged unethical practices of pharma companies. The NGO, which had moved the court in March, wants an effective monitoring mechanism, transparency, accountability, and consequences for violations of the code. Now, during the course of the hearing, the petitioner has accused the makers of Dolo 650 of allegedly bribing doctors with freebies worth 1,000 crore rupees to recommend the pills. On its part, Microlabs Limited, which makes the drug, has denied the allegations as baseless. About a month ago, the Income Tax Department had conducted raids at the drug makers' offices for alleged tax evasion. Another petition, which had reached the Supreme Court recently, had claimed that pharma companies were giving freebies such as gold coins, LCD TVs, fridges, laptops, and more to medical practitioners who, in turn, would ostensibly create awareness about their drugs and health supplements. The government too has acknowledged in Parliament that it has received complaints of unethical practices by pharma firms. The impact is that doctors might over-medicate you, the patient, or push you towards buying more expensive alternatives. Doctors, on their part, are bound by a code of conduct that prohibits them from accepting gifts from pharma firms. But the firms continue to operate with minimum constraints. And big money is involved. According to a Citizen Civic Action Group analysis, between 2008 and 9 and 2016 and 17, the 7 largest Indian pharma firms spent 34,187 crore rupees on marketing. At present, there is no regulator for pharmaceutical marketing practices. Unless the UCPMP gets statutory backing, there will be no associated monitoring or regulating body. To rein in these firms, the government brought in the Uniform Code of Pharmaceutical Marketing Practices in 2015. The code was brought in as a voluntary set of guidelines that would prevent pharma firms and their agents from plying doctors with gifts and cash to increase their sales and profits. But it has been found that these rules are being flouted without any major repercussions. It falls upon pharma associations to enforce the code, and they don't have the power or the incentive to punish erring firms. This code is yet to be legally implemented. That could change with the Supreme Court hearing the petition. It has now asked for the centre's response. So, why is it still a voluntary code and not legally binding on companies? Ramesh Sundar, the president of the Federation of Medical and Sales Representatives Associations of India, told Business Standard that the government had been dragging its feet for several years on implementing the UCPMP. A previous Business Standard report said that sector watchers believe that the code is caught up in a tussle between the Department of Pharmaceuticals, or DOP, which comes under the Ministry of Chemicals and Fertilizers, and the Union Ministry of Health. Malini Aisola, co-convener All India Drug Action Network, said that ethical marketing and promotion should be brought within the ambit of the new Drugs, Medical Devices and Cosmetics Act being formulated. If that happens, the role of the nodal ministry, which would administer the statutory provisions, would shift to the Union Health Ministry. but the DOP does not want to give up its turf.
A practice of providing some sort of a freebie, again, can be divided into multiple categories, right? One is where you are providing something for the purposes of education, right? Or you are providing something in the form of a brand reminder. These are things that as an industry practice needs to be done so that the healthcare practitioner is aware of the company, their products, and it will actually be for the betterment of the patient itself. Where there is an issue is where there is an incentive to prescribe. And that incentive to prescribe is what needs to be prevented. Now, the penal sanction for healthcare practitioners begins at rupees 1,000, right? And that is why you find that low value items technically don't actually trigger that penal sanction. But there is still a lot of ambiguity in terms of how many times can I provide a low value item legally. Yeah. A pharma company today is not prohibited from providing these kind of undertaking these kind of activities to healthcare practitioners. The restrictions apply on the healthcare practitioner side. There is no principal legislation under which you can put down the UCPMP. The effective way to do this would be to create an anti-kickback statute, right? And in that anti-kickback statute, we have to really balance the interests of the patient as well as the industry as well.
The Medical Council of India's regulations prohibits doctors from accepting gifts, travel facilities, hospitality, and cash or monetary grants from pharmaceutical companies. There is another law that comes into play.
If we see the Prevention of Corruption Act, while it is applicable in relation to undue gratification given to public servants, the question arises whether a medical practitioner is a public servant. Now, the Supreme Court has earlier in one of the judgments held that officials of a bank, including a private bank, are public servants. Can we draw analogy here to extend it to medical practitioners? Is there a need for the government to now look into even the uniform code for pharmaceutical marketing practices to now be given a statutory status? Could they do it by incorporating something similar what they did for advertisements under the Consumer Protection Act, by bringing a separate regulation for this aspect also? Maybe the answer lies there.
At the time of the publication of the UCPMP, the government had informally communicated to the industry that failure to comply with the code by the industry as a whole would force it to make UCPMP mandatory. Given the patchy adoption of the code by the industry, the government may be left with no option but to enforce the code as a law.
During the hearing, Justice Chandrachud said that he too took Dolo 650 to cope with the recent bout of COVID-19. From pharma firms and doctors, let us now move on to something which concerns your retirement. Employees Provident Fund Organization, or EPFO, is evolving. From investing in traditional instruments, it has been exploring the virtues of markets for a while now. So, is the statutory body's bold move bearing fruits now? Let's find out.
Millions of private sector employees park their money with the Employees Provident Fund Organization, or EPFO, to ensure a hassle-free retirement. But do you know where EPFO invests this money to give you those good returns? And do they invest in equities too? The government recently told the parliament that the retirement fund body has invested rupees 1.59 trillion in exchange traded funds, or ETFs, as of March 2022. And the investments are now worth rupees 2.26 trillion. This means EPFO has in notion made rupees 67,000 crore from its ETF investments. ETFs are funds that track the yield of indices such as Nifty or the Sensex. But unlike mutual funds, the units of ETFs are listed on the stock exchange. EPFO's total corpus is anywhere between rupees 16 trillion to rupees 17 trillion according to the latest available data. And it has traditionally been a big investor in debt securities. Currently, the retirement fund body invests 85% of incremental deposits in debt instruments, mostly AA or above securities. EPFO's debt investments are worth about rupees 14.46 trillion. Starting 2015, the government allowed it to invest 5% of the investable deposits in equities. Currently, the fund body invests up to 15% of its investable deposits in ETFs. It is also allowed to directly invest in listed shares of companies with a market cap of over rupees 5,000 crore. However, it invests only in ETFs and not in individual stocks. The investment in ETFs is made based on Nifty 50, Sensex, Central Public Sector Enterprises, and Bharat 22 indices. The body had invested rupees 43,568 crore in FY22, rupees 32,000 crore in FY21, and some rupees 31,500 crore in FY20 in ETFs. The objective of EPFO investments in equities was to provide good returns to its subscribers in the long term. An analysis shows that equity markets have given higher returns than the debt markets. In the last 5 years, the average return on investments in Sensex and Nifty was 18%, while the government debt and highest rated corporate yields stood at 6.8% as of March end. On the other hand, the return on EPFO's debt investments was 6.78% in FY21 and 7.5% in FY20. It was 8.5% in FY19. The fund body's notional equity returns on EPFO equity-related investments increased from 14.6% in FY21 to 16% in FY22 according to the government. Some experts say EPFO's allocation to equities has been on the conservative side according to a Thinking Ahead Institute and Pensions and Investments annual joint study. The top 20 global funds on an average invested 41.7% of their assets in equities, while North American, European and other regional funds have invested a majority share in equities. Asia Pacific funds have largely allocated assets to fixed income investments. So, do restrictions around equity investments cut down the potential of higher and more sustainable savings model for the body?
So I think it's a nice breakup. 15% is also not something which will break your portfolio if something goes wrong. So nice choice in my opinion. And this is really long-term money. So I think it's a good choice. But as I said, there are many challenges to this. If I were, let's say, so I probably be more okay with something like a 25% exposure. But then I would also say that, for the equity exposure, instead of guaranteeing them returns, you give them units just like in case of mutual funds. So let the investors carry the risk of the equity investments. Government should not carry it. EPFO should not carry it. Why does EPFO? So EPFO will guarantee returns, whatever the return is, 8%, 9%, on the non-equity portion of the EPF allocation. On the equity allocation, we allot them units. Let them, and then we shall see how that goes. So the risk must lie with the investor. If that is the case, I think I see no harm in increasing this to 25%. But yes, in the current form, if you keep increasing this because of all kinds of lobby pressures, I don't think that's the right way.
The safe investment bets, mostly in fixed income instruments, are also mainly due to the largely unpredictable nature of the market and the fact that EPFO has to offer fixed interest returns year after year to its over 60 million subscribers, irrespective of its underlying portfolio returns. There have been some news reports that the allocation to equities might rise to over 20%, but the government so far denied such a proposal.
I also feel that the true benefit of equity allocation having added to the overall asset allocation is not really being enjoyed by the members because of the way the accounting is being done. Yeah, I think if you look at the way to add equities in the retirement fund investment allocation is to bring in member choice, right? Which essentially means that the PF scheme needs to be amended. It's going to be a difficult task, but the way forward is that this whole thing of guaranteed interest rate will have to be slowly done away with, because equities and guarantee is a recipe for actually disaster. Imagine you go to a mutual fund and ask him to give a, say, 8.1% interest rate guarantee on their balance fund. They would shy away, they would not do that. The regulator, SEBI, would not allow that, right? So it's, from a go forward basis, I would think that if equities were to deliver significant return to members, it has to be done through employee choice or member choice, which requires scheme level reform.
There are mixed views on whether EPFO's equity investments are conservative. However, in the long run, EPFO may need to go beyond ETFs that track two major domestic indices and make more diversified equity investments. The pension fund may also look at global diversification of the overall portfolio.
But many experts believe that investing in equities or market-linked instruments is better due to the spiraling inflation. The consumer basket in India has been adversely affected due to the high food inflation and weak macro environment. However, a gradual pickup in consumption along with easing global commodity prices is expected to ease margin woes of FMCG companies. Let us find out how.
Prices of palm oil, wheat, edible oils, and crude oil have corrected 20 to 50% in the past 1 month. This can largely be attributed to improved supply chain dynamics and tapered demand in global markets. As supply issues recede, analysts expect commodity prices to cool off further in the coming months, providing margin relief to the consumer goods companies. On their part, companies like Hindustan Unilever, Britannia Industries, and Nestle India expect margin pressure to continue in the second quarter of this fiscal. But analysts expect a turnaround on a quarter-on-quarter basis from the second half of FY23. FMCG majors may also halt their successive price hikes amid abating inflationary pressures. This, analysts say, will augur well for volume growth in the second half of this fiscal.
We believe that the fall in commodity prices should benefit the FMCG sector in the second half of this year. This solves at least one part of the problem for the sector, which was high input costs, which was leading to margin pressures. The other half of the problems for the sector is volume growth and sustenance of volume growth, which remains an area of concern. But companies which are showing market share gains, companies like Varun Beverages, companies like HUL should benefit from the lower commodity prices significantly because they are gaining market share in the significant part of their portfolio. Another company which we like in this space is ITC. Here too, we are seeing cigarette volumes picking up, apart from FMCG business also doing well. Another big positive for ITC is lower focus globally on ESG and ESG related investing, which has led to inflows in ITC and thereby outperformance. We believe this outperformance should continue. So our top picks in the sector are ITC, Varun Beverages and HUL.
The festive season and normal monsoons are other triggers that are likely to boost consumption.
The impact of the record high inflation has been seen on the demand to a certain extent, but then that has been very limited so far. This has been well reflected in the recent results that came out for the paint companies. Despite the price hikes that the company took, the volume growth was very robust, with only few pockets seeing very limited impact. Going ahead as well, with 30-40% correction being seen in the commodity prices and with the oil prices too coming up from their peaks, we believe that the inflation might be peaking out at these levels. Thus, with the festive season about to begin and with the correction in the commodity prices, the companies might not take further hikes while the demand might pick up from here. The monsoon too has been very well this time. The rainfall has been at 16% surplus. Thus, this might result in the revival in the rural demand, which was weak over last 1 to 2 years. Thus, the overall outlook for the FMCG sector remains positive, we see that the demand is expected to pick up from here, while the commodity prices softening would result in the trend reversal of the EBITDA margins, which would start reflecting from the second half of FY23.
According to a Nielsen IQ report, an 8% value growth in the first half of 2022 indicates a positive outlook for the current calendar year. It expects the FMCG sector to grow in double digits this year. On the bourses, shares of HUL, Britannia, Tata Consumer Products, ITC, Colgate India, and Marico have surged up to 43% so far this year. In comparison, the Nifty FMCG index has outperformed the benchmark indices, soaring over 14%. The Nifty 50 and the S&P BSE Sensex, on the other hand, have added 2% each during the same period. As regards today, crude oil prices, foreign inflows, and rupee movement will continue to dictate the market trend. F&O expiry for August series and the upcoming Jackson Hole meeting will also be on investors' mind.
After the FMCG companies, let us now move on to IT firms, which are now grappling with a trend called moonlighting. While most organizations frown upon it, workers seem to be liking it. Let us delve into this debate. Rishad Premji, chairman of India's fourth largest IT services company, Wipro, triggered a debate when he tweeted that moonlighting in the tech industry was cheating, plain and simple. Moonlighting refers to the practice of holding a second job outside of regular working hours. Most companies in India prohibit staff from taking up additional jobs over concerns like conflicts of interest, job performance, or misuse of an employer's resources. Premji's comments came just days after food tech startup Swiggy introduced a moonlighting policy that allowed its full-time employees to work on external projects for money or pro bono. This is subject to certain guidelines and restrictions. Moonlighting should be outside office hours or on weekends, and it must not affect productivity or clash with Swiggy's business. Swiggy said a significant portion of the working population discovered new hobbies and perhaps even an activity that provides an additional source of income during the COVID-19 lockdowns. The company believes that working on such projects can significantly contribute to both the professional and personal development of an individual. Swiggy's policy reflects a pragmatic recognition of the evolving nature of white-collar jobs, particularly in the dynamic IT and e-commerce sectors where asymmetric work schedules like those employed in global back offices or engineers leave workers with a lot of free time. This also holds true for those who work set hours or shifts. 2 years of the pandemic, which enhanced the benefits of work from home for employees, has deepened the trend for moonlighting. A survey of 400 people across the IT and ITES space by Kotak Institutional Equities in July revealed that an astounding 65% of the respondents knew of people pursuing part-time opportunities or moonlighting while working from home. This is also scuttling the back-to-office plans of companies. In the Kotak survey, 42% of the respondents said they would consider changing their jobs if they were not allowed to work from home. There was a case of an IT employee found to be working for 7 companies at the same time. He was caught when the HR managers at one of the firms found multiple active PF accounts in the employee's name. Many business leaders concur with Rishad Premji's view on moonlighting. Their concerns revolve around conflict of interest with regard to the employee working for a competition or divulging sensitive or proprietary information. Further, companies also worry about loss of productivity at the primary job if the employee overworks himself. Companies also don't appreciate employees making use of company time and material like laptops or software for their side gigs.
I will achieve, I will fly high, I am the eye
nation's trusted bank, SBI, the banker to every Indian.
Under the Factories Act, a worker cannot take double employment. But in some states, the law does not apply to IT companies. That is all for today. For more news, views, and analysis, please log into business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.